The hunt for yield will continue in 2013 as the Federal Reserve keeps interest rates at record lows and continues to buy treasuries and mortgage-backed securities to the tune of $85 billion each month. If the risk of owning bonds for income is escalating, perhaps a better bet is dividend stocks. Better values, the potential for price appreciation, and of course, a reliable dividend income stream. With that, we're on the hunt for the best dividend stocks for your portfolio. Joining me now is Peter Vanderlee, co-manager of equity and dividend strategies for ClearBridge Investments. Vanderlee co-manages ClearBridge's Tactical Dividend Income Fund, which was up over 17% for 2012 and yields 4.7%. He also manages ClearBridge's Equity Income Fund and Energy MLP products. Peter, welcome to the program.
Thanks for having me.
Before we get into stock picks, what's your outlook for dividend stocks this year? Does certainty over dividend taxes, the fact that taxes were only raised to 20% from 15% for those making over $400,000, relieve some of the pressure that had been weighing on dividend stocks?
Great question. In my view, the outlook for dividend-paying stock is very strong. In our country right now, we have 76 million baby boomers that are about to retire with insufficient savings for the most part. Let's just think about what that cohort needs in retirement. I would argue they need three things. They need income to supplement their lack of savings. They need income growth to stay ahead of inflation. And they need capital preservation as they're in the spending years of their lives. Dividend-paying stocks in the U.S. not only provide a yield that is higher than corporate bonds in many cases, a phenomenon we haven't seen since the 1950s, but also balance sheets are very strong, corporate America is very cash-rich, and free cash flow is abundant. And payout ratio, meanwhile, are near record lows, which sets the stage for corporate America to really step up on the dividend and provide that baby boomer cohort, for example, with an attractive income stream that can grow over time.
Right. And, Peter, with companies holding so much cash on their balance sheets, would you expect companies to opt for dividend increases, or do you think we would see more stock buybacks?
Well, that's another great question. So the conversations I was having with corporate America near the end or the latter part of last year really revolved around what was going to happen with respect to the dividend and the taxation of the dividend. The dividends didn't go to the marginal tax rate in terms of the taxation of the dividends, but they only went for the most part to 15%. Unless you're in the highest bracket, then it went to 20%. But it's on an even keel with capital gains, so there is no benefit really to use share buybacks over dividends.
All right, Peter, so then what are your favorite dividend stocks for the year ahead?
There are actually quite a few attractive dividend-paying stocks. Also, I would say there's other areas in equities where one can look for strong dividends or distributions. One such area is energy MLPs. The U.S. is undergoing a renaissance in energy production as a result of technological advancements in horizontal drilling and fracking. And the energy MLPs are really in the sweet spot of providing the necessary infrastructure to transport, move, process, refine these hydrocarbons. So not only are energy MLPs providing us with a very strong distribution today of around 6.5% on average, but also I expect to see significant distribution growth there in that space as a result of all the activity that is happening. So it doesn't just have to be in common stocks. There are other equity-sensitive areas in the market that are currently quite attractive.
So, Peter, what are some other names and specifically?
Dividends. So some examples, I'll give you a few examples. Energy Transfer Equity, the ticker is ETE. This is a energy MLP. The market cap is over $13 billion, and this is a general partner. They own the general partner units as well as the incentive distribution rights of two other MLPs, namely Energy Transfer Partners and Regency. And essentially, ETE as a company is very well positioned to grow the distributions over time, and is currently providing investors with a yield of over 5%. So that's quite an attractive proposition. In the common stock arena, I would point to a company like Kimberly-Clark, which is a leader in consumer staples. The stock right now is attractively priced, and it's yielding a little bit over 3.5%, which is more than the corporate bond for Kimberly-Clark is paying. And Kimberly has increased the dividend for 40 years in a row, and I fully expect that trend to continue, given that the balance sheet is strong and free cash flow is abundant. And then lastly, I would point to a company like Verizon. Verizon is actually a very attractively priced telecommunication company, which is yielding close to 5%, which is well above like a 5-year security in the fixed income arena for Verizon, which is only giving you about 1.4%.
Peter, you prefer Verizon to AT&T?
I think actually in the U.S. one can own both, and I actually like both AT&T and Verizon. The U.S. is moving more and more into a duopoly on the wireless side, with the best networks being AT&T and Verizon. And if you look at the growth that both AT&T and Verizon have shown, it's actually quite substantial. Verizon right now has about 100 million subscribers or thereabouts. Free cash flow is still growing as a result of the proliferation of data usage on their network, which is the result of all the devices that are connecting over their network, such as tablets and phones. So there's still a lot of growth ahead in that particular area, which I think is actually an attractive area from an investment standpoint.
Peter, thanks so much for coming on the program and sharing your insight. I so appreciate it and hope to see you soon.
Thanks a lot.
Peter Vanderlee, co-manager of equity and dividend strategies for ClearBridge Investments.